Brent crude crossed $111 a barrel on Wednesday. That was the 8th consecutive session in the green for oil, each one adding pressure to Australian petrol prices, household budgets, and the RBA's inbox. The March quarter CPI landed at 4.6% annualized, the highest reading since 2023. The headline was bad, but the RBA's preferred trimmed mean came in at 3.3%, a touch softer than the 3.5% the market had been bracing for. Inflation surprises to the downside set stage for RBA decision, one headline read. And for about 40 minutes around midday, the ASX 200 almost believed it, trimming losses to just 0.25% before resuming its long walk south. By the close, the index was down again, 7 consecutive sessions in the red, the longest losing streak in years. Healthcare bore the worst of it. Cochlear fell to its lowest close since 2015. CSL dropped another 2.4%. The sector that had spent 2 years acting as a safe harbor was taking on water faster than almost anything else on the board. Energy, meanwhile, ran the other direction. Woodside gained 2% after reporting March quarter production of 45.2 million barrels of oil equivalent, down 8% quarter-on-quarter due to cyclone disruptions, but with average realized LNG prices up 11%. Coal stocks moved harder. Whitehaven gained 2.9%. Yancoal added 3.7%. New Hope climbed 3.4%. Every session that Middle East oil prices push higher, Australian coal and LNG become more valuable, not just as commodities, but as negotiating tools. Which brings us to Beijing.
On the same day, Australian petrol prices were feeding a near 3-year inflation high. Foreign Minister Penny Wong was in Beijing, meeting senior Chinese officials at the Great Hall of the People. The agenda, according to reporting from the AFR, was fuel. Australia is facing a fuel security problem. The Middle East war has disrupted shipping lanes and sent oil prices surging. Canberra needs to lock in supply. And so Wong made an argument that would have seemed almost unthinkable 5 years ago, during the years of Chinese trade bans on Australian barley, wine, and coal. She reminded Beijing how much of Australia's gas, iron ore, and food China actually buys. Fuel crisis. Penny Wong reminds China of iron ore exports to secure fuel supply, the AFR headline said, with a directness that captured the geometry of the moment. Australia, the commodity supplier, was using its supply position as leverage against China, the buyer. The country that once absorbed punishing trade restrictions was now sitting across the table with a list of what it provides. The mechanism behind this matters. China's steel industry runs on Australian iron ore. There is no short-term substitute. SGX iron ore futures were sitting at $106.95 a ton during Wednesday's Asian session, not at crisis levels, but not soft either. And BlueScope's chief executive had already made the connection explicit, warning in local media that China's use of iron ore pricing as an implicit pressure tool cuts both ways. Joke's on us, BlueScope says China using iron ore against Australia, read the headline from the Australian, and yet Australia walked into Beijing and used the same card from the other side of the table. This is not how the relationship has worked for most of the past decade. Between 2020 and 2023, China imposed bans and tariffs on a long list of Australian exports. Canberra responded with diplomatic protests and WTO filings. The power asymmetry seemed fixed. What Wednesday suggested is that the energy crisis has shifted at least part of that geometry, because China needs Australian commodities to keep its factories running, and Australia is now willing to say so out loud in a diplomatic context. The question that matters for Australian markets is whether this leverage is real, or whether it is the kind that dissolves the moment it is tested.
The case that the leverage is real rests on 3 things. First, China's steel production is running near capacity and has no near-term alternative iron ore source at Australian volumes and grade. Second, the Middle East conflict is showing no sign of quick resolution. Brent at $111 and climbing puts Canberra under genuine pressure to secure supply, which means the negotiation is not performative. Third, the diplomatic temperature between the two countries has been improving since 2023, which means Beijing may prefer a deal to a confrontation. The case that it breaks is simpler. China has a history of tolerating short-term supply disruption to make a geopolitical point. If Beijing decides that accommodating Australia's fuel request looks like rewarding leverage tactics, the answer may be no, or a slow no dressed as bureaucratic delay. The 2020 coal ban lasted 2 years. Australia found other buyers. China found other suppliers at higher cost. Neither side emerged unscathed, but neither collapsed either. For Australian energy stocks, the near-term trade is clearer than the diplomacy. As long as oil sits above $100 and the Middle East conflict persists, Woodside's LNG pricing power improves. Coal stocks continue to benefit from the displacement of Middle Eastern supply, and the budget case for Browse, the $30 billion gas project Woodside has now put formally back on the agenda, gets stronger every week. Woodside puts $30 billion Browse on agenda amid energy shock, the West Australian reported Wednesday. A project that looked marginal at $70 oil looks very different at $111. The RBA meeting next Tuesday is the immediate verification point. Bond markets are pricing a 70% probability of a third consecutive 25 basis point hike, taking the cash rate to 4.35%. If the RBA pauses, citing the softer trimmed mean and the downside risks to growth flagged by the AFR, the relief rally in rate-sensitive sectors could be significant. If it hikes, the 7-day losing streak likely extends, and healthcare stocks face another wave of selling as long-duration assets cheapen further. The current evidence leans toward a hike. A 4.6% headline is politically difficult to ignore, even if the trimmed mean offers some cover. But the RBA has surprised before, and Australia's commodity position, the same leverage being deployed in Beijing, means the terms on which the economy absorbs this rate cycle are not purely domestic. The one thing Tuesday's decision will not answer is whether Wednesday's diplomatic gamble in Beijing worked. That verdict will come later, in fuel shipment data and in the posture China adopts the next time it needs something from Canberra. Markets can price the rate decision. The leverage question is harder to discount.